Effect of monopolies decision on revenue. When it comes to a monopoly's decision on revenues, the marginal income earned by selling one additional unit is not equal to the price of the good. This is because the firm faces a demand curve that slopes downwards. When the firm charges a uniform fee to all its customers, selling one more unit necessitates reducing the price of all the units the firm intends to sell. Consequently, the marginal revenue of a monopoly is lower than the price of the good, as illustrated in the table. It should be noted that the value of marginal revenue in the fourth column is consistently lower than the price of the good in the second column once the quantity exceeds 1. Moreover, the marginal revenue decreases twice as fast as the price as the quantity increases. Effect of monopoly's decision on revenue. The figure graphically illustrates the relationship between total revenue, marginal revenue, and demand for a monopoly. The left graph in the figure shows the total revenue curve for a monopoly, which is not a straight line and becomes flatter as the quantity sold increases, unlike the sweeping revenue curve for a competitive firm. Since the slope of the total revenue curve represents the marginal revenue, it indicates that the marginal revenue of a monopoly decreases as the quantity sold increases. Furthermore, since the sweeping revenue curve slopes downward after Q equal to 8, it implies that the marginal revenue of a monopoly can be damaging. The right graph in the figure shows that the marginal revenue of a monopoly is a straight line below the demand curve and it is steeper than the demand curve. Declining marginal revenue. When a monopoly increases output, the effect on total revenue is dual. A positive effect from selling an additional unit and a negative impact from lowering prices to sell one more item. The blue rectangle in the previous graph represents the positive effect of increased output, while the red rectangle represents the adverse effect. The net result of increasing production on marginal revenue depends on the sizes of the positive blue and negative red effects. Suppose the positive effect or blue rectangle is greater than the negative effect or red rectangle. In that case, the increasing output will result in higher total revenue and the marginal revenue will be positive. On the other hand, if the positive effect or blue rectangle is smaller than the negative effect or red rectangle, then increasing output will result in a smaller total revenue and the marginal revenue will be negative. Declining marginal revenue. Average revenue calculation involves dividing total revenue by the quantity equal to the price. The demand curve represents the average revenue, which decreases as the marginal revenue falls below the average income. Finding profit maximizing point. For profit maximization, the total revenue and total cost curves should be plotted with dollars on the y-axis and quantity on the x-axis. The profit maximizing amount is where the distance between total revenue and total cost is maximized and total revenue is greater than total cost. This requires the slopes of the total revenue and cost curves to be the same and the marginal gain equal marginal cost. Profit maximization, monopoly and competitive firm. The profit maximizing rule for a monopoly is the same as in a competitive market. Marginal revenue equal to marginal cost. The main contrast between these two is in the shape of the overall revenue curve. A competitive company has a linear curve, while a monopoly has a steeper slope. Profit maximization, monopoly versus competitive firm. To determine a monopoly's profits and profit maximizing quantity, we must find the intersection of the marginal revenue and marginal cost curves. The profit maximizing amount is the quantity coordinates of the meeting between marginal revenue and marginal cost. The profit earned by the firm is the difference between the price and the average total cost, with the profit maximizing quantity as the width. Competition monopoly and deadweight loss. Having a monopoly may reduce total surplus for society as prices are higher and quantities are lower in trust compared to a competitive market. The monopolist's price increase results in a producer surplus in the monopoly, but at the expense of a lower consumer surplus for buyers in the market. The difference between the price and the marginal cost can measure the inefficiency brought about by having a monopoly. The more inelastic the demand curve, the more significant the difference between the price and the marginal cost. One way to measure market power is the price cost margin, calculated by dividing the difference between the price and the marginal cost by the price. Why monopolies exist? When the cost of producing a product decreases with increasing output, a natural monopoly can occur where a single company services the market. This happens when the minimum efficient scale is larger than the market size. Such trusts are characterized by a firm operating in an industry where the average total cost declines over the entire production range and the minimum efficient scale is greater than the market size. Another type of monopoly arises when a patent or copyright grants exclusive rights to produce goods for a specified period. Patents are awarded to inventions, while copyrights are awarded to movies, books, computer software, and songs. Monopoly rights through patents and copyrights encourage innovation by incentivizing inventors to devote resources to invent new products or take risks and try new ideas. Price discrimination in monopoly. Monopolies that practice price discrimination charge different prices to different groups of consumers for the same product. This is because consumers have a different price elasticity of demand. For instance, senior citizen discounts at restaurants, lower airline ticket prices for flights with a Saturday night stayover, and lower college tuition for students from low-income families are all examples of price discrimination. The monopoly must identify and separate customers with low elasticity of demand from those with high elasticity to successfully price discriminate. Quantity discount is another form of price discrimination where a lower price is charged to those who buy more. Monopolies generate higher revenues when they price discriminate than when they do not.